Welcome to BizTV's Beyond the Brand. I'm Kelli Phillips. Today I'm joined by our accounting expert, Michael Reeder from Reeder CPA Group. Michael will tell us how business owners can use the tax code to their advantage. Even during tax season, it's not too late. Stay with us. We'll be right back with more of BizTV's Beyond the Brand. Season rolls around like clockwork every single year, but the tax code, well, that's a bit more complex. Here with some tips for business owners is Michael Reeder from the Reeder CPA Group. And I've got to ask, Michael, what can we do as business owners? Strategy has to play a role in this, in helping with our taxes.
Right. It's great to be with you, Kelli, and hi, everyone. So it sounds simple. It's just amazing how many both CPAs and small business owners and individuals, for that matter, just don't do this. Right, like the relationship, like the normal relationship between CPA and client has to be one in which there are multiple touch points throughout the year. The status quo for the last, since the beginning of time, I guess, has just been like when people hear CPA or tax preparer or accountant, a lot of small business owners, think there's this the dynamic is this. It's this relationship in which you just meet once a year during February, March, April to prepare last year's taxes, and then the return gets prepared. The accountant, puts some numbers into the tax software, outspits a tax return, and it's whatever it is, and then see you next year. And that has to stop. If you're not talking with your CPA throughout the year consistently, at least 2 strategic advisory meetings throughout the year, if not 4 or monthly, or depending on how big your business is or what your budget is. But it's really that simple. If you're not having a conversation with your CPA throughout the year, I don't even want to say chances, you're definitely leaving money on the table, because once you get into tax season and you're doing last year's taxes, once you're past December 31st, it's already too late on so many strategies.
Oh, so it is important because you could leave money on the table. Are there some other disadvantages? I know that some business owners think, well, if I'm meeting with my CPA, that means I'm spending more money with him or her. But in the long run, you're saying it could actually save you money.
Absolutely. So if the biggest cost, the biggest expense on so many business owners' income statement is taxes, right? And so you bring up a great point, Kelli. I always tell people that your relationship with your CPA and your attorney, you have to view them as an investment, not a cost. You have to view it as an investment, not an expense, right? Because bad accounting and no tax strategy, or basement bargain price, tax preparation, service charges, is more expensive than paying more, and we're not talking, crazy prices. My firm strives to provide proactive strategic services at reasonable fees. We're not the most expensive out there. We're not the cheapest either. But if, for the business owner that has that mindset of, I don't want to spend too much time with my CPA because they're going to charge me more, then, that mindset, that limited mindset, is going to result in them not having as proactive of a tax strategy, which is going to result in more taxes being paid. So when a business owner has to take in consideration not only the cost of the accountant's services, but also the strategy that's being discussed when you're working with the CPA team. Because you may pay a little bit more in CPA fees in exchange for saving thousands and thousands upon thousands of dollars in taxes year over year. And so when you net the two together, it's the cheaper option, if that makes sense.
Yeah, absolutely. Now, I know that some people, anytime they get an email or a phone call from their CPA, they're like, oh, what have I done wrong? Are there some things that you can tell business owners to do in advance of talking to their CPA to kind of open the door to that being fully transparent and honest with your CPA? Because if they're on your side, they are going to save you money in the long run.
Yeah, absolutely. You bring up a great point. So I feel like a big problem in the industry is that just like lawyers get a bad rap for nickel and diming, right? If any sort of, the business model of just, nickel and diming, right? Like, oh, like if I write this email to my CPA or my lawyer, if I reach out via phone, I'm going to get nickel and dimed. And so clients don't like nickel and dime, getting nickel and dimed. And so how we do it at Reeder CPA Group, we have our core service of tax preparation, business and personal, and tax planning. And so we arrive at a monthly fee, throughout the year, right? So, 12 monthly payments throughout the year. Of course, there's options to pay in full for a discounted price, et cetera. But what we have baked into the fee for core services is tax preparation business, tax preparation personal, and tax planning. Therefore, there's baked into the cake a couple touch points throughout the year at least of meetings during the year, after tax season, a touch point in the summer, a touch point in the fourth quarter. And during those conversations, that's where the magic happens. That is where things can be, strategies are discussed, and then subsequently the strategies are implemented, saving thousands and thousands of dollars. And if you're not having the conversation, then you're leaving money on the table.
And so many people think that, we start talking taxes in October. Is that too late to right some of the wrongs that have been done with your books?
It's a great question. So October is, I would say that it depends on what size of the business. For a lot of small businesses out there, startup businesses, and depending on the, I don't want to say exact dollar amounts, but I'll say this: having a touch point, like if you're going to only talk to your tax preparer during regular tax season and then also fourth quarter, right? Whether it's October, November, December, that's better. That's a step in the right direction. That's better than, right? Like that's better than only talking in January, April, January through April for last, in the current January through April for last year's taxes. If you're going to, in addition to that, also talk in October while you're still in the year, that's better than not even talking other than regular January through April. And then, it's encouraged to at least have two touch points, right? What we try to do is have a touch point, during regular tax season. We're preparing last year's taxes, but for a lot of our clients, they already know where they stand. There's no surprises there because we were already talking throughout the year. So then when regular tax season rolls around January through April, we're preparing the tax return. They already know where they stand. They already know where they stand. And then subsequent to that, we're going to have at least a touch point in the summer, like somewhere in Q2, beginning of Q3, and then for sure in Q4. And so if it's only going to be Q4, again, like that could be sufficient depending on the size of the business. And at least it's better than only talking during January through April. But it is encouraged to at least have 2 or 4 touch points throughout the year. Again, more times that you're talking with your CPA, that means that more strategies are being discussed, which means that strategies are being implemented, which means that there's more tax savings, both short-term and long-term. And then with all that being said, the tax planning conversation, it dovetails into other areas of financial and professional service. So what can start out in the context of tax planning in July, right? There will be substantive tax planning in that conversation. And then and then whatever the strategy is, we'll implement it, et cetera, et cetera. Is it investing in capital expenditures that you can take advantage of accelerated depreciation, taking advantage of certain tax credits. Are you going to control your salary and distribution if you're an S corp to save money in self-employment taxes, aka Social Security and Medicare taxes, putting family members on the payroll, self-employed retirement plans like a 401k or a SEP or a defined benefit plan, all of that stuff. We're talking about all that stuff. And then so all of those topics, and there's more, all of that stuff is being discussed. But then the tax planning conversation can then, segue into, oh, well, that brings up a good point, Mike, or, Mr. or Mrs. person on the CPA team. I need to get my estate planning in place, like this tax planning conversation is going to, motivate me to go talk to my estate planning attorney, or, I got to go talk to my financial advisor. I need to rebalance my portfolio, maybe do some capital loss harvesting, et cetera, et cetera. And then there are often times when we're having that tax planning conversation during the year where where for a lot of our clients, one or two of the tax planning sessions that we have during the year after tax season, right? Like May through December, we encourage them, one of them perhaps will have their financial advisor on the call as well, and or their estate planning attorney, depending on what's going on, because that taxes intersect other areas of financial and professional service, and so it's just when you have this type of working model with your CPA firm as the default, it is a framework in which you can you're talking, and so hey, like let's have the financial advisor join, and we can determine how much how much of a Roth conversion can you do between now and 12/31 in order to stay at the 24% bracket and not jump into like the 32% bracket, for example. When you have a relationship with your CPA in which you're having multiple touch points throughout the year, it doesn't just have to be you and your CPA. You can bring your other professional service providers onto, a meeting here or there, for even more value.
Michael, we've got lots of other questions. Will you stick around? We've got to take a quick break, but we'll be right back.
Absolutely.
We're back with Michael Reeder from the Reeder CPA Group, talking a little taxes and what can be done as far as building that relationship with your CPA and helping you save money long term. A lot of people think that once you hit that end of year, there's nothing that you can go back and retroactively do. But there are some guidelines in there that you can make some adjustments. Are there not, Michael?
There absolutely are. It's a great point, Kelly. So, for example, if you're already, if December 31st has come and gone, not all hope is lost, right? So what you see a lot, let's talk about S corporations, LLCs. So an LLC, I'm a big LLC fan. An LLC with one owner by default is taxed as a sole proprietorship. An LLC with two or more owners by default is taxed as a partnership. At any time, an LLC can elect to be taxed as an S corporation or a C corporation. There are certain instances where going to C corporation makes sense. For the sake of this episode, I won't rabbit hole into that. But most of the time for small business owners, electing for the LLC to be taxed as an S corporation makes a lot of sense because a lot of money can be saved year over year in self-employment taxes, which is another term for Social Security and Medicare taxes for self-employed individuals. And so the IRS, technically you're supposed to elect S corp status by March 15th of the year, right? So for example, for everyone listening, right, like Kelly and I are doing this episode on March 6th of 2025. And so if you wanted to elect for your LLC to be taxed as an S corporation for 2025, you technically have to do it by March 15th of 2025. However, the IRS is very lenient with late S corp elections. So you just file the same form that you would normally file to have your LLC be taxed as an S corporation, but you cite a certain section of the Internal Revenue Code at the top of page 1 of the S corp election form, and the IRS will allow the S corp election to still take place for 2025. And wait, it gets even better. If you are in 2025 preparing your 2024 taxes and you have an LLC and you made a bunch of money in the LLC but you're actually going to pay more in tax because your LLC is taxed for 2024. Like when you're in 25 doing 2024 taxes with your accountant, and the LLC is still taxed as a sole proper partnership, and there was a lot of income, there could be a big self-employment tax hit. However, you could still make a late S corp election for 24, in 25. And, like the IRS might sit on the application for 60 or 90 days, but they will eventually process it and they will accept it. I've been in this industry for 15 years, and they've never rejected a late S corp election filing. So S corp, late S corp election filings, huge. That's a big one. And, just because you're past December 31st, you still have time to do it, even for last year. We even have a couple clients where we're doing, like, a couple clients before they came to us. They first came to us and they're 2 or 3 years behind, and we're doing it for 2 or 3 years. Like, we're making it retroactive to 1/1/2022, and the IRS will accept it. There might be some penalties in that context right there, but there's the latest penalty will the penalty that's going all the way back to 2022 will be able to abate it. So S corp, late election S corp filings, IRS very lenient on them. Also, moving on from the whole late election for S corps, if you're past December 31st, so again, we're in 25 right now, doing 2024's taxes for a lot of our clients. Mm-hmm. You can still make an IRA contribution for 2024 all the way up until April 15th of 2025. Same with an HSA contribution back to IRA, both a traditional IRA and a Roth IRA contribution, up until April 15th of 2025 for 2024. Same with HSA, right? Health savings account contribution for 2024. You have until April 15th of 2025. And then also the employer contribution for a SEP plan, for a SEP retirement plan, or a simple IRA, and also profit sharing on a 401k, and a defined benefit contribution. If any of those types of self-employed retirement plans apply, you can make the employer contribution in 2025 for 2024, as long as you make it in 2025 before you file the 2024 business tax return. So those are just like two, S corp and employer contributions to self-employed retirement plans. Those are two big juicy topics of, all hope is not lost if you're past 12/31 and you still need to do things for last year. Despite the fact that you're past 12/31, you can still do those two things: late S corp elections and employer contributions to self-employed retirement plans.
There seem to be so many misconceptions out there, but basically what I'm hearing you say is you should not wait until April 10th to get some of these things done for filing for the previous year. You need to have these conversations, and they need to be ongoing, because if not, you could be leaving a lot of money on the table or paying the IRS a lot of money as opposed to pocketing that money. Are there some other misnomers out there that you can tell us about briefly?
Oh, gosh. Keyword briefly, right? Because as everyone's listening, I obviously like to, dive deep. Really, an extension is an extension is not a bad thing. That's just one that comes top of mind. People hear extension and they think like, oh my God, no. But an extension is actually encouraged, especially for small business owners. So you don't have to file your taxes by April 15th. Especially if you're a small business owner, it actually makes sense to go an extension. So you have the rest of the year through, like up until October 15th to, let the crazy noise of tax season subside, and to really, have a chance to breathe, to sit down with your accountant to like make sure that all I's are dotted and T's are crossed before you file last year's return. There could also be an audit mitigation strategy for waiting to file last year's return up until September 15th or October 15th of the current year. So that's a big misnomer, Kelly, that people hear extension and they freak out and they think that it's this bad thing. It's not. It's a good thing. As long as you have, you're not going to incur, if you file an extension, you're not going to incur any sort of penalty or interest, as long as you file by October 15th. But if there's any anticipated tax owed, as long as you actually make the payment as an extension payment by April 15th, even if you don't file the return until October 15th, then you're not going to incur any penalties. And then that gives you an extra 6 months to just, like I said, make sure all I's are dotted, T's are crossed, and maybe whatever extension payment you make in April, you get some of it back by the time you file. No penalties, get it back as a refund or apply it as a credit towards next year's taxes.
What benefit is it for individuals, and I really want you to speak on this, if they are working with their CPA and their CPA has them paying quarterly installments. There is a benefit for those folks, but some people are worried about, do I have to pay this, throughout the year? But what are the benefits of doing it that way?
The benefits of doing it that way are that you don't get hit with a big tax bill when it comes time to file, or if you only make it in the fourth quarter. Now, there's different schools of thought on it, right? I mean, so the tax system is a pay as you go system. So if you're an employee, if you get a salary, if you get a salary either from your corporate, government, not-for-profit job, or from your own S corporation or your own business that you own, for example, then you're supposed to withhold taxes from your paycheck, right? And then if you're self-employed, then you're supposed to, and you don't have a salary, you're supposed to pay in through estimates. Or if you do a Roth conversion, there's certain things that you have to pay in through estimates. And so the benefit of paying in as you go is that when you actually file your taxes, you pretty much have the majority, if not all of your taxes paid in. And you avoid getting, a slap on the wrist in the context of an estimated tax penalty. And so just, for budgeting purposes, out of sight, out of mind, just pay the tax. Like that's the benefit of paying quarterly. So when it comes time to actually file taxes, you're not getting shell shocked with a big tax bill. And then that gets back to, if you have a relationship with your CPA where you're always in communication throughout the year, the goal should be whether you're going to owe money or not, for depending on the strategy of the year, whatever's going on, right? Like the goal is to go into the holidays knowing maybe you're going to owe tax, but it because of certain reasons you're going to owe, as opposed to getting a refund or break even, or maybe you're going to get a refund or break even, et cetera, et cetera. But you go into the holidays knowing where you stand. That's the goal. Like a big part of not only are you saving money in taxes when you're having a constant dialogue throughout the year with your CPA, but in addition to that, when it comes time to file the taxes, there's no surprises, because you've already been talking about this stuff ongoing throughout the year.
Michael, as always, we appreciate you joining us. Quickly mention how folks can get in touch with you.
Absolutely. So you can go to my website, reedercpagroup.com. That's Reeder, REE, D as in David, ER, CPAgroup.com. And then also on LinkedIn, I'm big on LinkedIn, Michael Ian Reeder. Search for me on LinkedIn, Michael Ian Reeder. My middle name is Ian, IAN. And there's a contact us section on our website. Feel free to reach out. Me and my team would love to speak with you. All
right, Michael, as always, we appreciate your time today. Thanks for joining us.
Thank you, Kelly.
Thanks for watching BizTV's Beyond the Brand. Be sure to subscribe to the BizTV YouTube channel, where you'll find full episodes of this show, a 24/7 live stream, fresh BizTV content, and a few surprises each week to help you stay inspired.